Hey everyone, it's Doug the Retirement Guy with all your monthly ETFs. And today I'm bringing you a special edition, the best 10 monthly distribution dividend ETFs based on total return year to date. That's right, we're breaking down 2026, which so far has been the best monthly dividend ETFs out there. We're basically focusing on total return, the data-driven performance, and the monthly income power. Who is the winner? We'll find out here shortly. Before I do, I got to do a shout out to all of our Patreon supporters for helping us keep this channel alive. Don't be afraid. Go down in the description. You'll see a place right there. It says Patreon. Click on it. Join for free. And then if you can help support the channel, we really appreciate it. I also got to say a shout out to all of our over 13,000 subscribers. Thank you so much. We continuously add new subscribers every single day. Welcome to the channel if you're new, and welcome back if you're one of our existing ones that have been there. Let's get into today's information. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who's been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. So why do I focus on total return? Because it shows the real big picture. Total return is equals to the income plus or minus growth. So it captures it all. It includes both the price appreciation, which was growth, and the income, which is our dividends. It gives you a better choice of how to compare your investments of what truly matters. Okay? You're not getting into that yield trap to where, oh my God, we got this big, massive income, but we're losing it on the growth side. So it avoids all those misleading signals. And it basically is going to measure your wealth creation and focuses on long term. So don't get caught in the yield trap. Focus on total return, not just those distributions. So, and also I'm going to say this. Remember, the goal is to grow your money, not just collect a check. Okay, so you want to collect that check, but you also want your account to be growing at an equal pace or something above inflation. So this is why we use total return as our numbers. So fund number 10. This is WEEI. This is the Westwood Select Enhanced Energy Income ETF. Now, Westwood. The key factors to this, it invests in North American energy companies, specifically in oil, gas, and consumable fuels and energy equipment services. Income generation is designed to pay out monthly distributions. As of early 2026, it's boosted its high distribution rate to exceed over 11%. The strategy, the managers sell right out of the money call options on stocks in the portfolio to generate extra premium income to help buffer against market volatility. And it aims to deliver a lower beta, or market sensitivity, compared to the standard S&P energy sector. Now, the total return so far year to date, 19.18%. The yield of 4.62 and the growth of 13.58. So year to date, you can see we're at 4%. So already we're 5 months into the year. So you can calculate out almost forecasting what your 12-month package will be. The growth, we're seeing some strong growth in the first quarter. Will it continue growing? More than likely. But remember, these numbers can always change. They're only from what we see today. But total return so far this year, 19.18%. Not a bad number. Fund number 9, MRRA. This is the Bitwise option income strategy of MARA. So this one's going to give you kind of that seek into the Bitwise ETFs, how well they actually do. So the target asset, this fund provides exposure to the price movement of MARA, a stock that is highly correlated with the price of Bitcoin. Now they do use a synthetic exposure. Instead of buying a MARA stock directly, the fund uses option contracts, buying calls and selling puts to mimic the stock's performance. The income mechanism, it sells and writes those call options on MAR to collect those premiums, which are then paid out to investors as dividends. They cap the upside and they have full downside. This is one thing you're going to find this in call option strategies, that the cap side is going to be, it's capped on the upside, but you have a full downside. In exchange for the high monthly income the fund potentially gains are capped if MARA's stock price skyrockets. However, MARA's stock crashes, the fund will lose major value. But so far in 2026, we've seen a very strong 22% total return, a yield of 5.48%, a growth of 14.67%. So as we see Bitcoin starting to make some changes, MARA is starting to make some changes, and we're seeing it reflect into the numbers. Our next fund is going to be the NestYield, the EGGQ, the NestEgg Visionary ETF. Now, the EGGOs, the NestYields, have been very interesting portfolios. I've been watching them on the channel. We've done a couple of reviews onto them, but we've been really watching these things of how they're doing in today's markets. And this coming into it does not shock me, because it shows that they are actually performing the way that we expect. So the NestYield, its concentrated portfolio, unlike broad index funds, EEQ, is highly selective, typically holding only 7 to 15 stocks at a time. The dual strategy, the equity exposure, holds stocks directly or synthetically, using options like ITM put options to capture growth in tech leaders. The income generation, it uses an option-based strategy, selling out of the money call spreads to generate premiums, which helps to fund monthly distributions. It is sector heavy. The fund is heavily weighed towards technology and the industries around it, featuring names like Seagate, Bloom Energy, and VRTY. Monthly distributions are designed to pay regular income with a distribution rate that is historically hovering around that 6 to 9%, though it can fluctuate. But look at the numbers here. At number 8, their total return is 22.28%. Now their yield, 2.47, is going to get us into that 6 to 9% total year of 12 months. But it's also the growth, 18.65% growth rate. So you can see with it really selecting select pieces in that technology side, you're seeing some hard, aggressive growth numbers, which is really designed on the growth side. Now, its sister or brother, however you want to put it, the NestYields EGGY, or this is one everyone always calls EGGY, EGGY. Now, this is the Dynamic Income ETF. Okay. So when we take a look at EGGY, more of the features that they offer, the fund primarily seeks to generate high level of current income through a concentrated covered call strategy and other option overlays. Now, how is EGGY different from EGGQ? Well, on one hand, it holds a concentrated group of roughly 40 to 45 holdings, so a little bit bigger portfolio that they use, often focusing on those high momentum technology and energy names, very similar to EGGQ, the Seagate and the Bloom Energy. But they also use this, I call the shield. It's unlike a standard cover call fund. It protects with put options as a ladder put strategy to help hedge against significant market downturns, aiming to offer a shield during volatility. So the fund is built for income-focused investors targeting consistent monthly distributions. Right now, we look at this, a 10.02% yield with a 10.21% growth for a total return of 23.56 kind of shows you a more balanced approach that EGGY gives you than EGGQ. So this is why it fits into our number 7 slot, hitting that 23%. And remember, these are year to date so far. These are not long term. I mean, we're already 5 months into this, and we're at 23% total return. So at number 6, the Kurv Premium Yield Strategy, GOOP. This is the strategy of Google ETF. Now, Google, we know, has been on a run, but I think Kurv has actually done probably one of the better jobs across the board in the monthlies to give you an ETF to perform. Now, this uses a synthetic cover call strategy. The fund does not just buy Google stock. It uses a mix of call and put options to replicate the price movement, so synthetically long, while selling call options to generate high cash premiums. Now, monthly distributions is specifically engineered for income seekers paying out dividends every month. As of the mid-2026, the distribution rate has historically been in double digits, often between that 12 to 15%. Now, the cap is upside, okay? In exchange for those high monthly yields, your potential gains are limited. If Google stock, just basically skyrockets to the moon, this ETF likely only capture a portion of those gains because it sells call options acting as its own ceiling. The full downside risk, while the income provides a smaller buffer if Google stocks drop significantly, the ETF will basically lose long-term value across the board. Despite the complicated option strategies, it is a standard ETF structure, and it issues a 1099 at tax time. So there's no K1 requirements. There's nothing special. Our look at our total return so far, 25.94%. It's coming from the growth side at 20.13% already, and a yield of 13.84%. So overall, Kurv has done a great job with this fund so far, and this is kind of one of these, the train is in that station for us to gather up some returns still into the end of the year. At number 5, SPTE. This is the S&P Global Technology ETF from the S&P funds. Now, some of these I'm going to say you guys may not have even heard of. But this is how deep of the research that we do, looking at over 5,000 different ETFs that are out there. Now, the SP funds, the SP Global Technology, this one here tracks the S&P Global 1200 Sahara Information Technology Capped Index. Every holding is scanned by a third-party consultant to ensure it meets the ethical and the leverage ratio standards. Okay? The global large cap focus, while heavily weighted towards the US, it has a global fund. It invests in titans and innovations across all areas like AI, cloud computing, and semiconductors. Okay, because of their principles, they forbid high interest-bearing debt. The fund naturally tilts toward companies with strong balance sheets and high cash asset ratios. And monthly rebalancing the index so it rebalances itself, capping monthly to ensure no single stock dominates too much in the fund. So they normally try to cap at about 10% across the board. Now, this one is really, I put it more towards the growth side. The yield was not attractive to me, but the growth side of it was very attractive, and you can see 27.30% total return But when we look at the breakdown, the yield is minute and the growth is almost equal to the total return. So this is a fund that you would put into your growth section, like in a retirement fund or something like that, if you need heavy growth in a particular fund. Next, we get back into energy. Invesco SteelPath. This is their energy infrastructure ETF. Now, Invesco, the SteelPath is, this is one very important one lately because of the energy that's going on. It's a midstream focus. The portfolio consists primarily of North America midstream energy companies, including the Master Limited Partnerships, MLPs, and C Corps. Okay, Master Limited Partnerships, you're going to find a lot in the oil industry, in the gas industry, and actually in the pipelines accordingly. So you're actually becoming a partner into those corporations. The cash flow, like the Westwood Enhanced ETFs, is designed for income seekers and pays out monthly distributions. It uses a covered call strategy, so it writes sells out of the money call options on its holdings. This generates extra income premiums, plus it helps reduce the overall volatility of the energy sector. Now, the positives is because they're using the MLP master partnerships and the way they set up the ETF, there is no K1 tax forms required. And if you've ever been a part of anything like that, a K1 is like doing your taxes all over again for every single stock that requires a K1. So you could be doing your 1040 form 10, 12, 14 different times depending on the size of your portfolio. But the biggest draws for the PIPE, the PIPE, is that it provides exposure to the MLPs without the tax headaches. It issues a 1099. Now, this thing here, the infrastructure, the moat, it invests in toll booth style businesses. The companies get paid based on the volume of energy moved through their pipelines, which can be more sustainable than companies purely focus on the price of oil. They don't care what the price of oil is going through their pipelines. They just want to crank as much oil and gas that they can through their pipelines. This is why we call this one pipe, is because it's designed for the infrastructure, not the drilling, not the oil itself. You look at these numbers, 30.20% total return, yield 1.23%, and the growth at 28.42%. Now, right off the bat, I know people are going to look at this. I'm going to do this one more time since we're at number 4. They're going to look at this yield and say, oh, not enough income, not enough income. Well, these numbers I'm giving you are year to date. So you'd almost have to times this literally probably by 3 to 4, basically how it's structured out, because we have so much more time to build those yields up. But the growth, you can see majority of it, of the total return is coming out of the growth sector. And we see that in a lot of the energy stuff, that they're not yet paying big yields, but they are paying big growth so far. So now we get in the number. That is going to be a convertible equity alternative ETF. These are starting to become more and more popular. They've been out there for a long time, but they're now starting to become more popular because of that convertible equity. So CVRT. Now, the equity sensitivity. Unlike broad convertible funds that holds defensive bonds, CVRT specifically targets convertibles with high delta price sensitivity. This means it aims to capture more stock price upside. It's kind of a hybrid system, so you have some risk, but you're getting some reward. It offers growth potential of small and mid-cap tech stocks, but the floor of the bonds, if the stock crashes, the bond principal helps limit the losses. Okay, so they're using a multiple system. They're using bonds as their protective, but they're also going after those small and mid caps that are going to have the biggest potential for growth. Okay, Now, the firm itself has over 40 years experience with specifically in convertible bond asset classes. So this is nothing new for them. They have been there and they've done this for 40 years. So monthly income, the fund distributes income to shareholders on a monthly basis, which primarily draw from the investors looking for yields alongside growth. It does give you a high tech exposure because many of the high growth tech companies use those convertible debts to fund operations. The fund is naturally heavy in informational technology, offering over 45% of the portfolio into technology. We look at the numbers, total return, 33.29%. You can see why this is now number 3. The growth, 32% of that total return is from growth, and the yields making up the difference. So overall, another big growth fund. And that's what I'm finding is when we take a look at total returns, we're seeing heavy growth funds. And this can help some retirees who are needing to pump up their growth section, okay, versus always taking the high risk. At number 2, this one here, I will tell you straight out, never even crossed my mind, never came across it. When it came across our searching and our returns and everything about it, I was shocked that we actually have a wheat ETF, WXET. Now, this fund here seeks daily investment results before fees and expenses corresponding with 200% of the daily performance of wheat pricing. How many people, I really have to wish I could see everyone and have a hands put up. How many of you actually ever thought wheat would be the game player? Well, this one does it. This is a commodity exposure. It provides double long exposure to the wheat market without requiring investments or investors to open complex futures or margin accounts. Okay, because it resets its leverage daily, which is one thing. When I did these things, I went a little deeper into researching these. When I saw this one, I thought it was very important that they daily, they're changing their leverage. It is not intended for long-term holds. This is one thing I want to make sure people understood. Is this is not intended for set and forget or long-term put in retirement accounts and let it go. Due to the mathematics of compounding, holding it for weeks or months may lead to returns that vary significantly from the 2 times underlying of wheat price. So you can see I should have this one on here saying, warning, hesitant. This is a quick in-out type program. Again, wheat is a very commodity type application. It does use a standard tax reporting of the 1099 and monthly distributions. This one is that leverage commodity price that provides that monthly distribution. Historically around 1.8 to 2.2. But where and why is this one up at number 2? It's all in growth. Okay, we've seen a massive run on the wheat pricing. Now, this is not going to fit a lot of people's portfolios. This is probably going to be one of these of, quick in, quick out type applications. But the total return of up to 42.61%, it's crazy of what the fund actually has been able to do. And our number 1, the winner of the entire, is coming from YieldMax, which I know there's going to be a ton of comments down below. I'll never buy YieldMax. I hate YieldMax. I come back. I don't have any preference either way. YieldMax, I've covered YieldMax for a long time on both channels. YieldMax has some good products. YieldMax has some garbage out there. They manage them wrong. But the YieldMax Targeted 12 Semiconductor Option Income ETF, SOXY, is actually our number 1 fund across the board. Now, if you're not familiar with YieldMax's target, what they target is they try to target a 12% annual yield. Now, this is why we didn't do this on yield. We did this on total returns. Because a yield doesn't really much mean anything to me if we're losing it in growth. If we're losing the price of the share with that like NAV erosion or anything in that category, that 12% don't mean anything. but this is their target. So unlike a lot of YieldMax funds that chase to that possible highest yield, which can lead to massive price drops, SOXY specifically targets a more sustainable 12% annual yield. So they're doing the direct equity with call spreads. It holds a diversified portfolio between 15 and 20 semiconductor companies: NVIDIA, Broadcom, AMD, Micron. Okay, similar to what they do in Chippy. But what they're doing differently is they're not in Chippy, they're looking for as big a yields as they can. These guys are looking for only 12 points. It sells call options on holdings. This generates income at 12%. But unlike standard covered ETFs, the spread allows for more upside potential in the chip stocks that are skyrocketing. You've seen AMD has skyrocketed over the past 2 weeks. It's gone crazy. Okay, so this one's giving you more of that upside coverage that you may not get in other funds that are trying to give you more yield. Distributions. The fund is designed for income seekers, distributing cash to shareholders each and every month. And then the sector diversification. By holding a variety of chip makers, it reduces the single stock risk found in funds that only track one company like Intel or NVIDIA. Total return, 55.9% already in just 5 months of the year. Their yield at the 3.86 is getting them very close to that 12%, which would give you a total real 12% yield. But you can see the growth has really been strong in the first part of the year. I know we've covered this. We've watched the RMD go crazy. We watch NVIDIA kind of holding on its own. So the chip suppliers are actually generating those big growths. So in summary, again, number one is a YieldMax fund. I know there's a lot of people are going to complain about that. But you know what? YieldMax does do some good things and they do some bad things. So I'm going to be on both sides of the fence. So at 55.9%, SOXY is number one. Our wheat came in at WXET, came in at number two at 42%. The convertible coming at 33.29. And then we got into energy and an S&P fund, both at 30 and 27%. Google, this is the one thing that we talked about with SOXY. This is a single stock yield from Kurv, doing all at Google, still at 25.94%. And then the NestYield, the EGGYs, EGGY, and the EGGQ. I really like NestYield. I like what they've done. I think they have some products. I just need more time under their belt to prove to me of what I think is there. I think it's probably one of the EGGY is probably one of the most balanced that we have on this review across the board. So guys, let me know what you think. What do you think of the funds? Now remember, I told you this at the start. We're basing it all off of total returns, which means that's going to come from a lot from growth so far in 2026. But I think in these 10 items, it's easy to find some that are going to continue on all the way through the end of the year, like SOXY and probably GOOP and of course the EGGY products. I think those are going to be ones that you're going to see at the end of the year that they've had a great total return across the board. Great start to the beginning of the year, great finish to the end of the year. Let me know your thoughts in the comments below. I know some of you probably have not heard of these, but just shows you that we do the research and dig as deep as we can to give the information you need. If you do like what we're doing, hit that like button. It helps us out the most. And thanks of all for watching the channel.
Thank you for watching. Press the